Hello everyone, I'm Tammy Cash, Executive Vice President and Head of Marketing at Horizons ETFs. Thank you for joining us for this webinar on volatility ETFs. 7 years ago, Horizons launched Canada's first ETFs tracking the performance of stock market volatility. Back then, in 2010, equity markets across the globe were still in the early stages of recovery from the global financial crisis. At that time, the specter of high volatility was top of mind for many investors. Fast forward to today, and the behavior of volatility has surprised many investors. Who would have thought that being short volatility would be one of the top performing investment strategies of the last 5 years? Indeed, our best performing ETF is HVI, the BETAPRO S&P 500 VIX Short-Term Futures Daily Inverse ETF. HVI has generated an astonishing 46.4% annualized return over the past 5 years. Now that performance has attracted obviously a lot of investor interest. However, it's crucial to understand that volatility ETFs really aren't for everyone. Although they provide the potential to generate some significant returns over a short period of time, they also come with a high degree of investment risk. Also, volatility ETFs can be quite complex. And that's why we're thrilled today to have Steve Hawkins, our President and CEO, to go over the mechanics of our family of volatility ETFs. Steve will be addressing the history of volatility ETFs and their unique product design. He'll also tell you how they give investors exposure to volatility. And then finally, he'll give you some tips on how to effectively trade them. But before we begin, I'd like to highlight a few key points. If anyone has a question, please contact us at info@horizonsetfs.com. As well, following Steve's presentation, we'll be answering some questions that we certainly get a lot about volatility ETFs. You can also contact us directly through numerous channels, including social media. In your lobby page, you'll also find a reference link for all of our resource materials. It's the green button located on the bottom of your screen. Click it to access things like our volatility ETF product sheets and the overall Horizons product lineup. With that, now I'll hand things over to our President and Co-CEO, Steve Hawkins. Steve.
Hello, everyone. I'm Steve Hawkins, President and Co-CEO of Horizons ETFs. And today I'm going to talk to you a little bit about volatility. First off, I'm just going to give you a little bit of background on Horizons ETFs. We've been Canada's innovator of ETFs since 2007. We manage approximately $7.5 billion of assets under management right now, part of an $18.6 billion global ETF platform with more than 222 ETFs in 6 different countries. Innovation has been Horizons Capital from our very beginning in 2007 and continues to be that today. We have 3 primary suites of ETFs: our actively managed ETFs, our low-cost tax-efficient benchmark ETFs, and our tactical trading tools, which are our BETAPRO ETFs. With our 7 ETFs we have listed on the Toronto Stock Exchange, we have $7.5 billion of AUM. 24 of those ETFs are benchmark ETFs. 28 of those ETFs are actively managed ETFs. And then the 25 are our original BETAPRO ETFs, which we started listing in 2007. Now I'm going to talk to you a little bit more about volatility, and some of the topics that I want to cover today include what is volatility, how can you invest in volatility, the mechanics of volatility ETFs and how they work, understanding volatility futures contracts, and the proper use of volatility ETFs. So We get asked a lot, what in the world is volatility? And volatility is, simply speaking, a market condition that is easier to identify than it is to manage. It is impossible to replicate volatility in a financial aspects. We have to manage volatility with respect to the 30-day expectations of what the stock market is going to do. So it's always looking at the implied volatility. It's all about the expectation of investors on where the market is going to be in a future time period. I mentioned 30 days, but that's really with respect to the short-term volatility. But volatility as a whole is simply the expectation of what the market is going to be doing in the next shorter period of time.
I think we need to
Start over?
Yeah.
Because of the phone?
The phone and your intro, it sounds like you're reading it.
Oh, it wasn't good?
It wasn't bad. It just was, it sounded like you were reading it.
I left my phone in my office.
I'm so curious.
I thought you had
gave
it
it
on.
to Tanisha.
I thought you had it on a timer.
Okay,
yeah.
so we'll end this and start.
No, don't end it. Just literally start.
Okay.
And we can just trim this off the front.
Okay, so I'm trying to sound more cash.
A little more cash.
That's fair. Okay.
Yeah.
And no phone.
And no phone.
I'll do my best, but...
No, now you've read it once, I think it's going to be a little bit easier. Okay, we're listening.
And then I was just going to say, go to the intro slide and just leave it for like 10 seconds and then start.
Yeah.
Just so that we have a lot of room to...
There we go. I'm holding it now. And we'll be quiet. So we'll count down from 5.
Okay.
All right, you ready?
Go for it.
Hi, everyone. I'm Tammy Cash, Executive Vice President and Head of Marketing at Horizons ETFs. Thanks to all for joining us for this webinar today on Volatility ETFs. 7 years ago, we at Horizons launched Canada's first ETF tracking the performance of stock market volatility. And back then, equity markets across the globe were still in the very early stages of a recovery from the global financial crisis. And at that time, the specter of high volatility was certainly top of mind for many investors. So fast forward to today, and the behavior of volatility has certainly surprised many investors. Who would have thought that being short volatility would be one of the top performing investment strategies of the last 5 years? Indeed, our best performing ETF is HVI, the BETAPRO S&P 500 VIX Short-Term Futures Index Inverse ETF. Now that's a mouthful. HVI has generated an astonishing 46.4% annualized return over the past 5 years. And that performance has attracted a lot of investor interest. But it's crucial for everyone on the line to understand that volatility ETFs aren't for everyone. While they do provide the potential to generate significant returns over a short period of time, they certainly come with a high degree of investment risk. Also, volatility ETFs can be complex. And that's why we've asked Steve Hawkins, our president and co-CEO, to go over the mechanics of our family of volatility ETFs. Today, Steve will address the history of volatility ETFs and their unique product design. He'll also tell you how they give investors exposure to volatility. And then finally, he'll provide us all with some tips on how to effectively trade them. Before we begin, I'll highlight a few housekeeping items. If anyone has a question, please contact us at info@horizonsetfs.com. As well, following Steve's presentation, we'll have a chance to answer and address some of the common questions that we get on volatility ETFs. And of course, you can always contact us directly through numerous channels, including social media. Today in the lobby page, you'll also find a reference to our resource materials. This is a green button on the bottom of your screen, and you can click it to access things like our volatility product sheets and our overall product lineup. So with that, let's not hesitate. I'll hand things over to Steve Hawkins, our president and co-CEO. Steve.
Hi everyone, I'm Steve Hawkins, President and Co-CEO of Horizons ETFs. Thank you, Tammy, for the introduction today and for hosting this webinar. I'd like to thank everybody for being here. I know volatility is a very interesting subject. It can be very difficult to make investment decisions based on expected volatility. And we'd like to talk to you a little bit today about our volatility products and really some better ways that people can use them, and hopefully give you some insights into the products themselves and how they can be used to work best for you as an investment. So with that, I'm just going to talk a little bit about Horizons. We've been around since 2007. We were Canada's innovator then. We are still Canada's innovator today when it comes to ETFs. We're part of a global asset group from Murray, based in Seoul, South Korea, with approximately $18.6 billion in total ETFs, offering 222 products in 6 different countries. Innovation has always been our capital, and we offer 3 very distinct suites of ETFs: our actively managed ETFs, our low-cost tax-efficient benchmark ETFs, and our tactical trading tools, which are our BETAPRO ETFs. With our 77 products that we have listed on the Toronto Stock Exchange, we have $7.5 billion of assets under management. 24 of those listings are our benchmark ETFs, 28 are our active ETFs, and 25 are our original products, which are the BETAPRO ETFs. Today I'm going to talk to you a little bit more about understanding volatility, what volatility is, and how to trade volatility. Some of the agenda items that I would like to cover off today is really simply how can we explain volatility, how can you invest in volatility, how the mechanics of our volatility ETFs work, understanding the contango and backwardation of volatility futures, and how to properly use volatility ETFs going forward. With that, I'm going to just basically say volatility is investing in disruption. For us, volatility is a market condition. It's a very extremely and difficult process to invest in volatility. Volatility is typically referred to from or as the VIX index as a measure of volatility. And the VIX index itself is the measurement of implied and expected volatility of the S&P 500 over 30 days. When you look at how the VIX is actually calculated, only really mathematicians can figure this out. This is not something that the average everyday investor needs to be looking at or trying to figure out. It is impossible to calculate the VIX on a real-time basis, intraday, following any sort of market measure. With any sort of stock or ETF, you can simply look at the quote. With the VIX index, there's nothing for you to look at, and there's nothing for you to be able to calculate directly from the second-to-second change in the markets on an overall basis. So for us, volatility is an asset class that you can invest in. In 2004, the very first VIX futures contracts were listed on the CBOE. In 2009, the ETN VXX came out, which allows for exposure to the positive momentum of volatility. Shortly after that, in 2010, we launched our very first VIX futures contracts. At that time, we were only able to launch +1 and the +2 bull leveraged ETF. Finally, in 2011, somebody came out with a VIX inverse futures contract or ETF, which allowed us in 2012 to launch a single inverse ETF, HVI, which Tammy discussed earlier. For us, investing in volatility and for tracking volatility, we have to track an index that is measurable and calculated on an intraday basis, or could be calculated on an intraday basis. And for that, we had to use the futures indices that were created by the CBOE and are listed and published on an intraday basis and traded on an intraday basis. For us, ETFs are about providing liquid investable solutions for our clients. And the only way we could do that with volatility was if there was an underlying investment itself that was liquid and tradable on an intraday basis throughout our trading day. And that was finding something like the CBOE VIX futures contracts or short-term VIX futures contracts, which from there we were able to create the short-term VIX futures index, which is a rolling position of the futures contracts. So for us, understanding that the short-term futures index, which is what all of our ETFs track, are not actually VIX index. They're not actually volatility, because those are really uninvestable. So with the futures contracts, we know that it's investable, and those really have a very strong correlation to VIX and the VIX index, but they are not the one and the same thing. So we get questions all the time from investors looking at their TV screens and seeing the VIX doing one specific thing, and it could be up 50% that day, and our ETF is only up 20%, or our ETF is up 30% if we're tracking single VIX. And they want to know what is going on because we're not tracking it. But the short-term futures index has approximately an 80 to 85% historical correlation to the VIX. It is not identical to the VIX because the VIX is not investable. But anyway, that said, we have 3 different ETFs that we use to track volatility that you can invest in for the purposes of, depending on your investment philosophy, and it should be a short-term investment philosophy generally when you're talking about volatility or investing in volatility. But you have a +1, which is HVU. We have our +2, which is HVU, and then we have our inverse volatility ETF, which is HVI. Just talking about the details of the ETFs themselves. So HUV, which we commonly promote as a hedging vehicle because it provides single long-term exposure to the short-term volatility index. This ETF doesn't necessarily rebalance the same way that leveraged and inverse leverage ETFs work, so it doesn't get affected by the same methodology that is needed from a daily reset perspective. That said, investing in volatility over a long period of time really does have its risks. But with HUV, those risks are generally, from our perspective, promoted by using it as a hedging vehicle. So volatility, as you know, has a very, very strong negative correlation to the equity markets. So if the equity markets are going up, then volatility is generally going down. And if volatility is going up, then the stock market is generally going down very quickly or going down at a somewhat rapid pace. It may not just be instantaneous. When there is a huge stock market negative activity, then we see volatility always spiking very, very rapidly from that perspective. So if you own HUV from a long-term perspective, it can be used as a hedge, or a short-term or long-term perspective, but it can be used as a hedge without necessarily the theoretical methodology role issues that you might have with HVU. You will have positive performance from HUV when you have negative performance in the stock market. HVU, which is our double daily bull ETF linked to volatility, is much more of a day trading vehicle itself. It reacts very, very sharply and very quickly to changes in volatility. And volatility, as we know, can be a very volatile asset class. So this ETF itself is not for the faint of heart. It is for investors who, on a very basis, have an idea that they believe that there is going to be stock market volatility for whatever event could be happening. Donald Trump becoming president, BREXIT, which is an example we'll talk about later. These sorts of market events create market volatility. Recently we have North Korea and their ICBM testing and their issues with Donald Trump. Those things created market volatility for a day. And it's those types of issues that you can profit from owning HVU on a very short-term basis if you own it in the right direction. HVI is our inverse daily inverse ETF. It does reset similar to HVU on a daily basis because it provides inverse exposure. So we have to reduce our overall or increase our overall notional exposure of the ETF to the daily basis. But this ETF is generally, if we see a trend in the equity markets, which over the long term are positive, and we know historically that they are, then HVI should actually tend to go up on a very long-term trending basis. So we use this as almost a long-term equity replacement vehicle for us. I own it personally as a long-term investment as my equity market exposure, or one of my equity market exposures. But that said, this also is not a vehicle for the faint of heart from the perspective of you are going to have very short-term significant increases in volatility, which are going to reduce the investment value that you have for HVI. So this is not a vehicle where you really should be looking at it on a day-to-day basis if you have a long-term view. That said, when volatility spikes, it produces opportunities for somebody to essentially short volatility, because volatility tends to increase very, very quickly, very rapidly to a high level, and then recede from that. From a historical basis, that's how it has always worked. So when volatility increases rapidly, it's a very good time to short volatility. And how do you do that? You invest in an inverse volatility ETF. And there's profits to be made from shorting volatility. There always has been, and there always will be. So for us, I talked a little bit about it before. You have all of our ETFs are linked to the VIX Short-Term Futures Index. This tracks the near and next month VIX Index futures. We roll those futures, or the ETF's methodology is a rolling futures contract. We start by investing 100% in the current month, and then on a daily basis, we roll a small piece of the volatility contract on an overall every day until we are 100% out of the near contract and into the next month contract. This does not replicate the VIX, as I mentioned earlier, but it does provide a very high correlated return trajectory to VIX index itself, and that is historically in the 80 to 85% range. So using futures as exposure to the underlying index, the rolling methodology is very, very important to understand. So for you to be able to track your daily performance, if you want to, of your ETF, which tracks the index, which then tracks the futures rolling methodology, we publish how much exposure to each individual futures contract is made up every day for the index. So as an example, which is on the screen right now, for this specific day of August 10th, 2017, through the daily rolling process of the VIX futures contracts, we were exposed 15.79% in the index to the August contract, and we were exposed 84.21% to the September contract. Again, it's all part of the rolling exposure. It changes every single day as we roll a small piece of that futures exposure as part of the index methodology. Just looking quickly, this is our calendar. It is on our website. It's a resource. For you, it will explain to you when we start rolling those futures contracts and when we are 100% out of the futures contracts or into the next month's futures contracts. So this calendar is posted. Again, for those traders that want to specifically be able to calculate the returns that they're generating or what it is that they're exactly exposed to from a near and next month futures contract, this is a very, very important information page. And it's in our resources section. As Tammy was mentioning earlier, there's many different things in that resource section which refer to our volatility ETFs. And from here, you can see very specifically in the calendar what you have exposure to from a current month and the next month futures contract. I already talked a little bit about the role of the futures exposure, so I'm not going to get into that. What I do want to talk to you about is how the futures contracts work. And we know that historically, volatility futures contracts or more recently over the past 3 years, have been in contango the entire time. And I'm going to talk about it a little bit further, but we have a chart of when contango ETFs, or when the futures have been in contango and when the futures have been in backwardation. But essentially, contango is when the futures price is always higher than the spot price. So we're expecting that the price in the future to be higher than it is now. When there is a futures curve that's in backwardation, that means the expected future price is lower than the current price. For commodities and things like that, where you have cost of delivery, cost of storage, and things like that, contango is a very, very frequent thing. Also, with the expectation of volatility, there's always an unknown with respect to market disruption events in the future. And so volatility has tended to always be in contango over the past 3 years, and we've seen record low levels of volatility in that regard. We still see many instances of market unknown due to very specific news events, as we talked about earlier. And at that time, when those specific news events happen and volatility spikes, we can see very, very short-term events where backwardation might exist, but it has very, very quickly reverted back to contango in that regard, and has receded. Volatility and the VIX index has receded in value, and it's very, very obvious from that perspective. For volatility, as we talked about, and the VIX futures contracts, the 30-day volatility, or the contango, is much, much steeper than we see in any other commodity or investable commodity out there from a futures contracts perspective. So with the inherent rolling futures process that we, as part of the short-term volatility index and the underlying exposure to our ETFs, there is a built-in contango which results in potentially huge profitability from a rolling futures process for inverse ETFs, but it also results in a huge cost for single up and double up ETFs, more so for the double up ETFs. So if we are constantly rolling futures and we're constantly paying a higher price, that is a process which reduces the overall return of our ETF. So that's very negative with respect to rolling positive double up and single up ETFs tracking futures, the volatility futures, but it's a very positive return generation for HVI and inverse tracking ETFs to volatility. So you have an inherent long-term gain or loss built into simply the way that the futures roll on a month-to-month basis, and us and our ability to track the index on an overall basis. As we talked about, when does contango exist? And here we have a 5+ year chart of volatility in the futures contracts. The blue line shows the front month to the second month contango. And we can see from the red line where volatility, where there is no contango or backwardation. And we can see that historically the blue line is almost always above that zero-sum line. So it's always in contango, except in very specific circumstances where there's news events which have caused volatility to spike on a very, very short-term basis, and then it receded very, very quickly from there. So as we talked about, contango exists almost historically all the time, except for in extreme backwardation scenarios where volatility has spiked. For the fourth futures contract to the seventh futures contract, so looking out 1 year to 2 years on the roll methodology of the futures, we can see that contango has almost always existed from that perspective. So when you're looking out at volatility even farther along the futures curve, we can see that there are very, very few instances of backwardation at all in that period of time. So contango backwardation are really, really backwardation itself is something really only applicable to the current month to next month futures contracts. One of the, as I mentioned earlier, one of the questions that we always get is why doesn't the performance of ETFs really track volatility, and why doesn't it track what's going on in the marketplace when the TV reporters are reporting the VIX index is X. They never report what the short-term S&P 500 VIX index is doing, though, but that's what our ETFs track. And as an example to show you of how volatility ETFs work, what we've done is we went through Brexit, and we analyzed the performance of the stock market, the performance of the VIX short-term futures index, and the performance of our ETFs over several days. And what we've done here is we've shown that our ETFs, when looking at them on a consolidated performance basis, over a day or 2 days or multiple days from that perspective, our ETFs are tracking exactly the performance of the index that they should be. Now, it's very, very important to understand that HUV will track volatility on an aggregate performance over multiple days. It's also very important to understand that HVI and HVU, because of the daily reset mechanisms, will only track performance for that single day. So it has to be, you have to understand that when you own one of these ETFs over multiple days, you're not experiencing the performance on an individual day basis. You are looking at the performance on a compounded but reset basis. So your performance of the first day impacts your holdings, and then your current value of your holding is where the performance goes from the next day forward. So it's very, very different from ETFs that track performances of indices on an aggregate long-term basis. So these are short-term trading vehicles. You have to have a short-term trading view, or you have to have the heart and the stamina to be able to invest it in these and understand what it is that you are owning over a longer period of time. Here's a chart of the performance that we just talked about, and we're looking at it over a period of 7 specific days here, and when Brexit happened, and what happened to the performance of our ETFs over that period of time. So we can see that the VIX index, which is demonstrated by the orange line, was down from the 22nd to the 23rd, spiked from the 23rd to the 24th by 49.33%, and then continued to recede very, very quickly over the next 3 business days, where it dropped almost 20%, or 21% over those next 3 business days. We, on a controverse, you can see that the short-term VIX index didn't go down as much as the VIX index on the 23rd, didn't go up as much as the VIX index on the 24th, and then continued to go down, just not as quickly over the next 3 business days to the 28th, and then slightly increased again on the 29th. Whereas you see what the S&P 500 did, you see the huge drop in the S&P 500 from a relative basis of 3.59% on the 24th after the announcement of Brexit vote. And then we can see what generally happens with equity markets after a huge decline is they start to rebound. Sometimes they rebound slowly, which is what happened from the 24th to 27th, and then there was a larger increase from the 27th to 28th, and then it was flat on the 29th. When you look at the performance of our double volatility up ETF, which is HVU, we can see that our ETF on the 23rd had positive performance of 1.34, sorry, I'm looking at the wrong chart, the blue line. So it had negative performance of 26%, 26.3% on the 23rd because volatility was down by 13.21%. So almost double volatility going down because there was no information at that point in time. The implied volatility of the market was lower. After the Brexit vote, with respect to the S&P 500, we see volatility spiking. And we see the short-term index going up by 32% over the course of that business day from close to close. And what do we see? We see HVU going up 66%. So almost exactly double again what happened to the short-term VIX futures index. And then the next day we see it receding, and we see our ETF going down by approximately 8.64%, when we see volatility going down by approximately we see the short-term VIX futures index going down by 4.3%. We see our ETF going up, down by 8.6%. So just from a daily tracking perspective, we see HVU tracking almost identical, 2 times the performance of the short-term VIX futures index. Relative to the CBOE VIX index, we can see that they are not the same, but they are relatively the same from a tracking perspective. They're in the same direction, and it is tracking roughly 80 to 85% of that index. Here are the very numerical calculations that we did on a day-to-day performance, on a historical performance of the index versus our 3 different tracking ETFs. And it just shows you as well where the VIX index is relative to the VIX short-term futures total return index, which is what we track. So here's a historical performance for your information. And as Tammy mentioned, the HVI ETF on a 5-year basis has returned 46.4% on an annualized basis, and since inception has returned 42.29% as of July 31st. So those are huge annualized average returns, and this is one of the reasons why you can invest in contango of volatility over the long term. So again, we talked about how the VIX and the short-term VIX index are very different on an overall basis, but we also know that the VIX is a long-term historical negative performer. And because of that, you can invest in HVI over the long term and expect to profit from long-term negative volatility. If volatility goes up, you're going to have negative returns. But over the historical longer term, HVI can be a very positive performer. On the controversy, HUV and HVU, are always going to tend to go negative over time, because volatility always tends to, over the long term, go down relative to the stock market going up. These are inversely correlated to stock market returns. So if you want to get positive stock market performance, you will invest in negative volatility, or you will short volatility by buying HVI. If you are negative over the short term of the stock market, then you might buy HUV and HV or HVU as either a longer term or a shorter term vehicle from a hedge perspective, or to profit from that short-term volatility. So if you think that you have a long-term negative view on the equity market and maybe you want to hedge some long equity exposure, then HUV might be a longer-term play for you. And because it does not have a daily reset mechanism in it, it can work better over a longer period of time. HVU, on the other hand, because of its reset mechanism and because of its double leveraged version of the index, it reacts very, very quickly to small changes in the performance of volatility. As we talked about, volatility is volatile. So you have to be very, very careful when you're investing in HVU for any period other than on a short-term basis. And when I say short-term, these are day trading vehicles. These are not for investors who want to invest over the long term with a negative view on the marketplace. We would have to recommend do not invest in HVU over periods longer than any one day. Over the the past 3 years, specifically, volatility has been very low. And because of that, HVI has done very, very well. And when we see, if we ever see volatility start to increase from a historical basis again, then you're going to really have to look at your long-term views of volatility, and you're going to have to look at your long-term use of volatility. Contango will likely tighten from that perspective because the spot price will be higher relative to the longer 30-day implied volatility of the marketplace. So you have to reassess what is your view of volatility, what is your view of investing in volatility as an asset class, and you have to determine at that point in time what type of vehicle will best match your view for investing in volatility. With our 3 different vehicles, we offer multiple different choices for meeting those different investment philosophies investing in volatility. For us, we get a lot of different questions with respect to how we determine the net asset value for volatility. As we talked about earlier, there is a daily futures allocation from the near month and the next month futures contracts, and it's really the closing prices of those futures contracts which really determine the closing value of the index that we use for the different volatility ETFs. With our HUV and HVU, we use specifically the SPVXSP, which is a published rolling futures index, and we're able to strongly correlate the returns in the net asset value to the closing value of that index every single day. So it's very transparent from that perspective. With inverse volatility, just due to the simple structure of inverse volatility, we weren't able to peg it directly against that Bloomberg published CBOE futures index, and we had to create our own short VIX futures index, which is posted on Bloomberg every day. It's CMDY VXER. It uses a different closing price. It uses a 4 p.m. approximation of the closing index value, whereas the SPVXSP is the actual 4:15 settle prices for the futures contracts with the relative weights of the different futures contracts in it. So very different from an overall basis, but ultimately the same correlation to the VIX index or substantially similar correlation to the VIX index from that perspective. You just have to be aware that there is slightly different valuation methodologies between an inverse volatility ETF and the single up and double up volatility ETFs. Some of the things to know with respect to trading ETFs, and very, very specifically our volatility ETFs, please always use limit orders. You know, you might have the right view on volatility, but as we talked about many times, volatility is volatile, and the prices of some of these ETFs can change very, very rapidly in a single day. We've seen huge price fluctuations of HVI and HVU very easily in one day in the 10 to 30% range. That said, intraday, which these ETFs trade very actively, it is very important to know what you feel is a good price limit to enter the order and to stick with your limit orders from that perspective. So putting market orders in on volatility simply to get exposure can result in damage to your investment philosophy because you have not entered into your investment at the right price. So please use limit orders. We also, once you own a position, once you have acquired a position to the ETF, it is very, very important to understand what your limitations of owning that ETF are. So where is your investment philosophy? Is it short-term or long-term? And if it is long-term, if it is short-term or long-term, you should always be using stop losses because volatility can result in significant gains, but it can result in very significant short-term losses, unexpected losses. When unexpected market events happen and you are long volatility, either in single or double, you can result in losses very, very quickly. And if the stock markets go up very, very quickly, you can continue to lose money if you're using these as a hedging vehicle or if you've used them as a long-term negative view of the market. When the market goes down very quickly, we can see losses happen very quickly on HVI. So you should know your limits from an investment perspective, and you should know where to draw the line with respect to stop losses for these vehicles, but we would always recommend using stop losses for volatility ETFs. With all of our ETFs, we also say please stay away from trading right at the beginning of the day. One of the primary reasons for this is because there's too much noise going on in the marketplace, both at the start of the day and at the end of the day. Things move very, very quickly at the start and at the end. There's a lot of market players out there. They're trying to digest a lot of market information, all the overnight information in the morning, and then going into the end of the day, there's a lot of people that are just trying to get on or out of their positions for the purposes of covering shorts or for getting rid of their long positions. So there's a lot of extra volatility at the start of the market when the market is digesting information, and at the end of the market when there's different players in the marketplace for reasons that could be of any type. So it just creates more volatility of volatility at those points in times. You know, all of these ETFs trade reasonably actively throughout the day on the Toronto Stock Exchange. HVU is typically in the top 15 most traded securities on the TMX every day, trades with very tight spreads, bid-ask spreads. HVI also trades very, very actively with tight bid-ask spreads. HUV, which is the single volatility, may trade a little bit thinner than the other two, or typically trades a little bit thinner than the other two, because when people are investing in volatility, for some reason they're looking for very short-term, or sorry, not for whatever reason, they are investing it properly for the basis of very short-term view, which they're trying to profit from or protect their own other investments from. So we use these for that purpose. HUV, because it has a much more longer-term structure from an ownership perspective and can be used as a longer-term hedge, much like a normal inverse equity ETF. We don't see the volume trade as high for HUV as we do for HVU or HVI. So, some of the things. Did you know that we are the only provider of leveraged and inverse leveraged ETFs in Canada? Yes, we are. Did you know that we're the only provider of volatility ETFs in Canada? Yes, we are. And today, between our leveraged and inverse ETFs, which include all of our volatility ETFs, those represent close to 38% of the cumulative Canadian ETF market volume. That is an astonishing number for the fact that our leveraged and inverse leveraged ETFs, which make up less than 5% of the overall number of ETFs in Canada, can represent more than 38% of the cumulative volume of trading of ETFs in Canada. So that is an astonishing fact. Our lineup of leveraged, inverse, and volatility ETFs is listed here. We provide access to many different equity and commodity asset classes, as well as we provide inverse exposure to the broad TSX 60 and the S&P 500 and to volatility itself. In summary, I can say that volatility can be your ally, but there are many risks with respect to trading volatility. You have a high tolerance for risk. There's much, much higher risk over the short term and longer term from trading volatility as an asset class. But the potential rewards can be very, very high for those that trade it in the right direction. So understanding the mechanics of volatility ETFs is very, very important. Understanding that volatility is typically in contango with respect to the futures, and that contango can result in annualized yield automatically built into inverse volatility ETFs, whereas it provides a cost and negative performance to single up and double up volatility ETFs. And most importantly, when you're trading in volatility ETFs, please trade with care. Please use limit orders. Please use stop losses. And please look at the market when you're trading your volatility ETFs. Having a liquid market to trade a volatility ETF or any ETF is very, very important. Volatility ETFs are only as liquid as the underlying asset class themselves, and this asset class is very, very liquid. And there are many, many direct investors that want to trade these on a day-to-day basis. So it's very important to know what's going on in the marketplace, be following the news, make an informed investment decision, and please trade with care.
Great. I want to say thanks to Steve. That was a really great overview on practical tips for investing in volatility ETFs and some very important trading considerations that I know will really resonate with all of our listeners. Let's now switch gears slightly to address a few more of the common questions that we're getting about specifically our volatility ETFs. And Steve, you mentioned in your presentation that we tend to notice with volatility that it spikes over very short periods of time. In your opinion, do you think that this underscores the idea that these really are short-term trading instruments? You've been pretty crystal clear about that. But
So, it's very, very important to understand that trading volatility has to be based on a short-term view on an overall basis. So, especially HVU as the most volatile ETF that is out there from a price perspective in Canada. With those short-term spikes in volatility, you can make a lot of money very, very quickly from owning this product. But over the long term, we have significant long-term negative performance for HVU. And so this vehicle should not be held for multiple days. It is a day trading vehicle based on a very specific short-term view of the marketplace. And you can always profit from short-term spikes using vehicles like this, but it's better to have a longer-term view on an overall basis and profit from something that is going to provide you with longer-term performance, similar to an HVI or investing into the long stock market itself. So TSX 60, you have HXT, and S&P 500, you have HXS. So these are long-term equity play and philosophy type investment vehicles.
So here's one that we get from time to time. Why is it that there's no -2 times inverse volatility ETF?
It's a good question, and I'll go back to the origination of our ETFs. And when we launched our volatility ETFs, when we did them originally, it was only a +1 and a +2. And it wasn't until 2 years later that we were able to structure the structure of an inverse volatility ETF. It was very, very difficult. As we mentioned here, there's a custom index that we use for the inverse volatility ETF because we had to strike prices at different times to be able to manage the hedge for the inverse volatility. And that said, shorting volatility is much more difficult than getting long exposure to volatility because of the futures contracts out there. Right. And for us, these are all synthetic structures, and they're all basically reliant upon our ability to find somebody who will provide us the synthetic structure that will allow us to track the objective of the ETF. After 2 years of the banks in Canada becoming more comfortable in trading volatility, we were able to structure the inverse volatility ETF. We have never been able to get somebody comfortable enough to provide us -2x exposure to volatility. There are too many unknowns with respect to the spikes in volatility and the information out there, and the ability of one of our bank counterparties to be able to undo or add to the exposure required for us to provide a -2x ETF and then manage that exposure on a day-to-day basis for the reset involved with it is just too costly, too much risk to it, and we didn't believe that that type of vehicle would be well received by the Canadian marketplace.
Got it. The next question is actually specific to our ETFs. Investors have commented that they've seen quite a few consolidations with HVU and HUV, and also splits with HVI. Can you expand for our listeners how these work and how they have an impact on a client's exposure to the actual performance of the ETF? Because this is one we get frequently.
Thanks, Tammy. Yeah, it is a good question. It is something that we are talking about all the time to our clients and wondering why we're doing things. It's very important to understand that for efficient trading of an ETF, there really is a good price range for ETFs to be trading for end investors at the end of the day. If an ETF is trading at $1,000 per share, it is generally too expensive for an end client to buy a board lot, which is typically 100 shares of an ETF where it trades efficiently. So on the stock exchange, when stocks become too costly, they will typically split. And if the price becomes too low, they will traditionally consolidate because people want to be able to trade the stocks efficiently. So for us, where we're trading volatility ETFs, and as we talked about, there's a long-term historical trend of these to be volatility to be negative, that results, plus you have the issues with respect to the contango and the futures curve, you have traditionally ETFs that are going to be always going up in value and ETFs over the long term that are always going to be going down in value. And if they are traditionally always going down in value, and that's HUV and then HVU compounded because of the 2 times nature and the resetting of it, it can go down very quickly over short periods of time as volatility has decreased in value. And vice versa, HVI can go up in value very significantly over a longer period of time. And because of that, and we want to keep the prices in the correct pricing trading range for clients at the end of the day, typically we always have to have ETFs trading above $3, we prefer $5, and typically below $40. So if an ETF is approaching one of those range limits, then we will typically look at consolidating it if it's lower and splitting it if it's too high, because we always want to keep the price within that trading range. It's very, very important to understand that a split or consolidation does not affect the overall value of the units that you have. So if you buy 100 units at $10, you've paid $1,000 for your units. And if all else being equal, the next day, if we split that, so now the price is $5, you own 200 units. So you own 200 units at $5, you still own $1,000 worth of that unit. If we consolidated it from $10 to $20, now you own 50 units at $20. So you still have $1,000 value of your ETF units. So splitter consolidation, which happens very regularly for stocks trading on stock exchanges around the world, and it really is to keep price trading efficient. We just have to do the same thing with volatility ETFs, and we have to do it more regularly because of the long-term trends of volatility going down, which results in the price changes of these ETFs going down very quickly for HVU and going up for HVI. Simply that.
Thank you, Steve. I think that really clears up any misconception about exposure overall. Any final words for our listeners who've tuned in today?
I just want to say thank you all for listening. I apologize for the length of talking about volatility. There's a lot to be said. We can be on the phone talking about volatility and our volatility ETFs for many, many hours every single day, but we encourage you to please read the prospectus before investing in volatility ETFs. It's very, very important to understand the structure of the ETFs, what it is you're investing in, what it is you're getting exposure to. So please read the prospectus. Please understand what it is that you're investing in. Please understand your view of investing and making sure that you are picking the right vehicle to get exposure to volatility.
Great. With that, on behalf of Steve and all of us at Horizons ETFs, thank you so much for joining us today on